Welcome to the Book Club interview with your host, Scott Hollister, a show that empowers you to discover your best self through a deep understanding and review of books dedicated to self-improvement and business.
All right, welcome to the Book Club interview. My name is Scott Hollister, your host. Today's guest is James Kandasamy, who wrote the book Passive Investing in Commercial Real Estate: The Insider Secrets to Achieving Financial Independence. James, welcome to the show today.
Hey,
How
Scott,
you doing?
happy to be here. Thanks for having me here.
Yeah, thanks for coming on. We were having a great conversation before about passive investing. Glad you wrote the book because there's not much out there when it comes to the passive investor side. So it's a phenomenal resource to have for anybody that's interested in investing in passive commercial real estate.
Yeah. I mean, as I, if you look at any commercial real estate investment, unless people are doing like single family home where one person do the whole thing, right? But nowadays with syndicated commercial real estate becoming very popular, or has become very popular, 95% of the investors are passive investors, and I wrote a book to tell them how they should be become a smarter passive investor, because there's tons of book out there for active investors, but they're just 5% of the overall population, right?
Smart man. I love it. Well, before we jump into the book, you want to tell the listeners more about yourself and where you've started in the real estate field?
James Kandasamy, staying in Austin, Texas right now. We own like 1,300 units right now on our own, of course, with our passive investors. But the count is very important for me, because that's one thing I mentioned in the book, because so much of abuse in the unit count that a lot of people are making is, this is not including passive investments or, we being a KP or any other deal. This is purely, we are managing it directly. And we are operators, which basically we are active asset managers. To take it further than that, we actually own our own property management and construction management, on top of raising money and doing asset management as well to buy deals. So deals are primarily in Austin, San Antonio market, in Central Texas, but we have investors nationwide.
Oh, that's great. Now, in terms of the first sentence in the book that kind of really caught my eyes, and it was like, "Don't read this book." So I think that was from Robert Allen, who wrote the
correct
the intro there. So when did that real estate bug first bite you?
The first bug was because when I did my first deal, maybe I was moving to my second deal. After my first deal, well, I got it was a 45 units, and there's like 4 investors in it, including me, is 5. And I know we really worked hard to find the best deals out there. We underwrote it conservatively. We did a really good job, bought it at really below market. And one of my investors who were really impressed with the work I did, and he had probably like 500,000 to 600,000, and he invested a small amount, maybe I believe 100,000 into my deal. And he said, I asked him, what did you do with the rest of the money? Oh, he said, he invested in all the other deals. So that was a bit shocking to me, because for me, not all real estate deals are the same, right? But I think the way this passive investor was thinking is that he's thinking real estate is the same, right? All operators are the same. So I'm just going to put money across 10 different deals, right? So I'm going to get the same returns, right? So he didn't really think about hey, I need to underwrite this deal, or not underwrite, I need to characterize each of this deal and try to make it suitable for himself and be a smarter investor. So, because when I asked him what are the criteria you use to choose all the other investment, he said, no, I just put blindly into all the other deals. And I was like, why? So the thought process of passives in a lot of groups is like, everybody's the same. Market is hot. It's a fear of missing out, right? So they just want to get all the money out. They think everybody's going to be giving the same return, performance is going to be the same, but they didn't think about the market. They didn't think about the operator. They didn't think about their own life investment cycle. They didn't think that. They didn't give me a really good answer. That's what I feel. So that's why the aha moment bite me to write a book for passive investors. Hey, it's not the same as all investments are the same, right? Like if you go and buy a stock, right, you're going to do a lot of analysis on who's behind it, who's the management, is it a good value that you're buying, what's the stock performance. But what this investor did, and I also realized almost everybody do that, or a lot of passive investors do that, especially when they are, when they're in a certain group, they just blindly put money into whoever gives them the deal, right? So that's why I thought, okay, I need to write a book so that I can educate my passive investors on how to become a smarter passive investors, because I think for me it's important, right? And that's the reason I wrote the book. That's why it bite me. So
yeah, well, that's good. Yeah, no, it's a good bite, because I think anytime you can talk about education, that's phenomenal. So you talk about education as the first step in the book, and obviously the best place to get started is to read your book, and then from there grow. And you're talking about getting out and meeting people. Now, you talked about the 3 W's of passive real estate investing. So with the understanding of what, where, and why, we become empowered to make better investment decisions. So how do we get away from being that blind investor in the sense of the 3 W's after that education?
I would say, before you go and entrust your money with someone, go and start networking, right? Go to free networking events, meetups, right? Even Bigger Pockets I mentioned in the book, right? Start there, right? It's a free account. Bigger Pockets has, almost 1 million people there right now, right? So many people who are successful there. You can just ask questions, just ask some even stupid questions. It doesn't matter. There's a lot of people who will help you. Even you go for meetups, right? And talk to people, right? Because a lot of times in commercial real estate, especially on a syndicated commercial real estate, it's a private LLC operation. It's a business by itself where it's private, right? A lot of people don't talk what happens after the deal closes, right? And there's no forum for you to go and find out because it's all private, right? So the only way for you to get information is, go and talk to other people in meetups, in Bigger Pockets, or just try to reach out, to, if you want to invest in a deal, just reach out to the passive investor already invested in that deal in another deal with the same sponsor, right? So just, getting to know people, networking will avoid a lot of traps on making a bad investment decisions.
Well, that's amazing. I love that. Get out, network, ask great questions, and just keep learning. So the passive investor is not going to spend too much time or any effort managing the deals, depending on, each deal is a little bit specific. So you talked about some of the benefits of being a passive investor: cash flow, tax deductions, and leverage. So if you're talking to someone who's brand new and maybe they've just invested in stocks, so how do you explain, some of the more complex tasks to the first-time investor?
Well, let's say, for example, a person who invests in stocks, right? So I would start with talking about the risk versus reward thing, because stock does make a lot of money, right? So the chances of you making money in, the amount of money that you can make in stock probably is 3 times more than real estate, but the probability of you making money is less, right? So there's a probability versus chances, right? So I did write a blog post where, like, stock versus real estate, right? What's the difference? And there's a chart in that blog post which talks about how volatile is stocks, right? It goes up and down so quickly within few years, right? And versus real estate is a slow and steady, but you do make money, right? So it's a risk versus reward return, and plus the probability of you making that amount of money, right? So I would start from there, right? And after that, I talk about how real estate is an asset class, which is a hard asset class, right? It's not going to disappear, whereas stock can disappear, right? So real estate is not going to go, and so that's the second thing I would mention. And the third thing I would mention definitely of the tax advantage, right? Of course, all this is on top of the returns that you're going to be making on real estate, right? Which is the annual returns and back-end returns too when you sell the deal, right? Where you build up the equity for the right deal. Right. So these are things I would mention, which I think would make sense for a lot of stock investors.
Awesome. Now, in terms of like considerations passive investors should make when looking to invest in a deal, and I loved how you gave 3 examples in the book, and you eventually led to the IRR, which was a really good metric to check out a deal. And what do we look like, and how do we pair up with an investor with the same goals?
So I'm trying to understand your question. So we're talking about the metrics and how do you pair up with the goals? Okay, so basically you have to look at what each investors want, right? Where they are in their life, right? So that's one thing I talk about in the book, that investors should have different need in their life cycle, right? And that's where they should be investing with that objective in their mind, right? Not like the guy I told you in the beginning, where he just invests into every deal he saw and he thought everything's going to work out fine, right? And surprisingly, I think probably half or maybe 20-30% of this deal didn't really work out. So, right. So, I would say every investors need to look at where they are in their investment cycle. What is their goal? Is it more cash flow, or do they want to double in terms of their equity, or do they have a good paying W-2 job right now, or are they at the end of their W-2 job and they want to retire, right? So based on that, I would say investors who are looking more for cash flow towards the end of their investment cycle, their cash flow is important. They just want the cash flow. They don't care that doubling the equity, and they have a large amount of money that they have, probably like $1 to $2 million. They can look for cash flow type of deal where the IRR rate doesn't matter. Their metrics would be more on a cash flow metrics, right? But there's also a trick, right? So after 2015, there's a lot more deals that were being done or current being done using IO loans, right? IO is interest only. So you have to look for cash flow during interest only period, and you have to look for cash flow after interest only period, right? So a lot of sponsor doesn't show the cash flow after the IO period expires. So you have to be careful with that. So what I mean, coming back to the original questions, is people who are in that investment cycle should look for more for cash flow rather than looking at IRR itself, right? Whereas investors who are looking at both cash flow, but they emphasize more on doubling the equity or increasing the equity by a large amount, and they have a solid, stable W-2 job, and they have a smaller fund. They can look at more into IRR, right, which focuses a lot on the back end or at the sale of the property, because IRR, a lot of it is driven by the sale, the equity build up at the end, right? So they can focus a lot more on IRR, right? But IRR can be used for both. I would say, as long as the focus is right in terms of the cash flow versus IRR and what you want, you'll be fine. It's a bit hard to use IRR for a cash flow deal because, like you can buy, a deal which is just cash flowing very nicely, but there's no appreciation, right? And your IRR will be lower, right, compared to a deal which has a small number of cash flow but has a big NOI or equity build up at the end, right? But the second part of the investors, where they want a lot of equity, they also have to understand they're taking a lot more risk compared to the cash flow guys, because cash flow is today. You're getting the money, like you get the money today. But IRR, you're hoping 3-5 years from now, the cap rate is going to compress and the market's still going to be good. And, you are taking a bit more risk, but that's the risk versus reward, right? They're taking more risk, but they also have a solid W-2 job, and that's the risk they have to take, right? Whereas the people who want to retire, they do not want to risk their money that they have on a back end equity build up, which is not really promised or solid, right? Because it all depends on the market.
Well, those are great explanations, and I think that leads into my next question is the operator, right? And we agree on this point 100%, and it's believing in that deal sponsor. So the person that puts forward that the business and the plan and executes it. So what do you look for in a person or a company when let's say you're investing in other deals?
First of all, I want to clarify the operator, right? So the operator is a person who's an active asset manager. He most probably would be the guy who underwrites the deal, right? So a lot of times nowadays, after the introduction of the Jobs Act in 2015, where 506C has become more popular, right? Where you can just do, it's openly advertised, and is open to accredited investor, 506C. Because of 506C, what's happened is, a lot of a lot of people out there, also raising money and being involved in the GP ship, right? So, but you have to really find out who is the operator in the GP ship, right? So, because nowadays there's a lot of people. If you look at the operating agreement, there's a lot of people in the GPs, and you have to look for who's that one person who underwrote the deal, who knows the exact numbers behind the deal, and underwrote it and said that this is a good investment, and they're going to execute the business plan. Usually, it's a bit hard to find that person because, as I said, after 2015, the GP ship has become a bit muddy. So identify the operator, right? So once you find the operator, the way to, underwrite them, underwrite the operator, right? I would say.
Exactly.
The best way is, if you have never worked with that operator, is basically to ask the passive investors who have invested with them before this, right? You have to understand that new operators do become really good after a few deals, and you can't sideline them. But new operators also come with a risk because it's the first step they're doing it, right? Mm-hmm. And I think that's the best way to do it. Just ask the current investors who have invested with them. How did they do? Did they really communicate well in their execution? Are they being responsive in their communication? How is the performance of the deal, right? Are they taking in charge of the deal, or are they being a leader, right? Do they have a business experience? So these are the things I would look for, because running a multi-million-dollar, large multifamily or any commercial real estate, it takes a lot of business skills and leadership skills, and usually you don't find that when the market is good, right? From 2009 to now, market is good. Like, so a lot of people. I'm not saying that I'm different, and I'm also helped by the market, but there's a lot of skills that an operator brings to the table. But just understand that everybody's a champion in a bull market, right? So the best is to ask the passive investors who have invested with them on how did they do in their current deals or their past deals.
No, rising tide raises all boats. But that's I like that. That's important. It's finding that one person that's really understands the asset. And I do some fix and flip loans on the side, and my biggest thing is looking at the operator. And I say this very loosely, I could care less about the market, the deal, or whatever, because if I know and I trust that person 100%, they're the expert, right? It's more about trusting them, and that's kind of that step when it comes to being a passive investor, right? You're relinquishing some control and giving it to that person that you believe in. Exactly.
Sometimes passive investors go too much into the numbers, into the market, and they listen to all single detail that being told during a webinar. Key things they want to look at: can I trust this guy with my money? And all right, can you do the work?
Exactly. Right? So next step is analyzing the deal. So how do we get past that overwhelming feeling of getting the first deal, and how to focus on those fundamentals when you're just starting out?
It's hard, right? Especially on your first deal, because even when I did my first deal, I could not analyze the deal. I mean, I'm just surprised how many newbies are getting started, and I think that's part of the lot of limitation that newbies have, right? Because they just don't know, how do I work out this deal, right? So when I did my first deal, when I look at the P&L, I got this deal through off-market marketing, and of course, there's no brokers to tell me what is the upside. They didn't have a nice OM to talk about the location, the town, and all that, right? So I just have a rent roll and financials. So it took me some time to really go through the numbers, and I found out the numbers were wrong as well. They had capital included as part of the expenses. So almost a week, I just gave up on it. And after a week, I was thinking something must be wrong, because the price per door that I'm buying is really, really low compared to the market, because I was buying like 35, and I know everybody was paying like 50 something. So then after some time, I realized there was a lot of capital included as part of the expense. So it's just a matter of sitting on it and analyzing it. And I also had a mentor to help me out to go through that. But during that process of me figuring out capital as expense, they didn't help me out. But it's just a matter of, analyzing the deal slowly and peeling the onion in the financials.
I like that. Peeling the onion. That's a good saying. I'm going to remember that one. So we're recording this May 2019. So what are you looking for these days when it comes to analyzing a deal at this time in the market?
Oh, this time of the deal, I mean, right now, I didn't even underwrite any deal for the past, until yesterday. For past 3 months before yesterday, I didn't underwrite any deal because market is too hot and I know most of the deals out there that not going to really make sense, right? So, so I have good reputation in my current local city brokers. So they will call me if there's a deal, right? That they think that I'm going to buy because they're not going to send me any deals out there too, right? So, but at the same time, I just bought like almost 1,000 units in the past 12 months. I thought of, okay, let me cool down here. We were focusing a lot on operations. As I mentioned, we own our own property management. And I was like trying to tighten up a lot of operational issues. We were introducing a lot of systems right now in our deals, in our operations that I think is important for me to slow down. So, but nowadays, when I look at a deal, I usually will look at 3-4 parameters only to really determine whether it's a good deal or not, right? So, so I only look at a few things before I decide on my next move on the deal.
Oh, great. Now I have a question on the bringing the property management in-house as well as the construction. So I hear it helps a lot with, having a personal hands-on touch, but it really doesn't add to the bottom line. Can you speak on that while bringing it in?
Well, we had our property management since day one when we started in 45 units itself.
Okay.
Yeah, it doesn't add a lot to your bottom line. You're not going to make money with property management company, but it does give us control, right? And a lot of times when we do value add deals, especially the deep value add and even value add, it gives us a lot of control to turn around the properties, right? And my wife and I, we are like a bit control freak, so we want to see every day what's happening with our deal, right? Because we have investors' money. Investing based on our name, and we want to make sure that we really, really work on it, right? So it's very hard. It's very, very hard for us to not look at operation every single day, even though if I give it to third-party management and we realize, okay, why not we just do it ourselves, right? So, and we have set an expectation, right, on our managers, and we would not have that control if we give it to third-party.
Well, that's good. I love it. Keeping it in-house. All right. Yep. Before we pivot to the end of the show, I'd like to ask these 2 questions. So what's the best advice you were given when it comes to business and real estate?
It's all in the mindset, right? So that's the aha moment at some point in my life when I was doing my W-2 job, and I read a book called Magic of Thinking Big, right? So it's all in the mindset. You just have to believe that you can do it, right? So I think it's the same in real estate too. It's all about mindset. If you think there's a deal out there, there is definitely a deal. If you think there's no deal, market's peak, there's definitely no deal.
Yeah. Wow, that's beautiful. And that's a great book. I love that. Magic Think It Big. That's awesome. And you yourself, I mean, you're quite the educated person when I was reading your background and your bio and where you've come from. So can we talk a little bit about that before we wrap things up?
Well, I'm an electrical engineer with an MBA, and I have a CCIM now, which I just recently obtained after owning 1,300 units. So that may not be, it's not costing me, that CCIM doesn't cost me. It's not the reason why I buy so many deals within a short period of time. No. Education is just, I'm not saying it's nothing. Like engineering, right, teaches you how to solve problems, right? So college education is not about subject matter, but it's about simulating your entire life in an exam situation, right? How do you handle pressure, right? How do you solve problems? That's what for me, my degree taught me, right? Especially my engineering degree. How do we solve problem? How do we analyze problem? How do we peel the onion to solve the problem, right? Methodologically thinking, right? That's what engineering taught me. It really did. And I can take that and use it for real estate, because real estate needs a lot of creative thinking on how to solve problems, right? And you have to solve problem real estate to make a lot of money. Otherwise, you'll be just like a normal real estate investor, and MBA just taught me that, in the financial world, there's a lot more money to be made compared to engineering. That's what MBA taught me.
That's good.
Yeah, correct. I mean, yeah, that's what it is. I mean, I think it's anybody can do what we are doing as long as they have the mindset and persistence. All right, so
Good.
that's what I think. I mean, I'm not saying education is nothing, but I'm just saying that you really don't need that to come up to what we do.
Yeah. Wise words. I love it. All right. Best place to find out more about you and where to purchase your book.
My book can be bought at Amazon. It's Passive Investing in Commercial Real Estate. I don't know whether this is going to show correctly. Yep. Correct. Amazon, I did release a 3 version. One is Kindle, a physical book, and also Audible because I'm an Audible guy. So you can find it in Amazon. I can be personally, accessible through my email, James@Achieve Investment Group, James@achieveinvestmentgroup.com, and my website is achieveinvestmentgroup.com. I'm very active in my multifamily investors group Facebook group. The Facebook group called is Multifamily Investors Group. There's like 1,000 people right now. We just launched it like 1.5 months ago, and we have like over 1,000 people right now. I'm very active there, and I have a lot of people who are engaging in conversations over there as well. And also, I'm going to be launching a podcast. It's called Achieve Wealth Podcast. Achieve Wealth through value-add real estate investing, where I'll be interviewing a lot of operators.
Great. Well, that sounds good. I'll make sure I link all that in the show notes. Well, awesome. James, thank you so much for writing the book, 1, and 2, for coming on the show today. I really enjoyed it.
Hey, thanks, Scott, for having me. I'm really happy to be here and talking about my book.
Thanks so much for listening to this show of the Book Club Interview with your host, Scott Hollister. If you enjoyed today's episode, please leave a review and subscribe. And we'll catch you next time on the Book Club Interview.